And I think Bitcoin, stablecoins, and tokenization is just the tip of the spear. I think we're going to see maybe 6 major use cases bubble up next year. I think you're going to see ICOs bubble up. I think you'll see digital identity. I think you'll see privacy. I think you'll see a DeFi renaissance. I think you'll see a DPIN renaissance. I think thinking that crypto is Bitcoin, stablecoin, and tokenization is like thinking that the internet is email, search, and Amazon. What about social? What about Uber? What about mobile? What about Zoom? What about podcasting? There were a million more use cases. We have not reached the end of history in crypto. We have 3 use cases. We're going to have 30. And I think next year is the year that those are going to start to bubble up into the mainstream.
When Bitcoin slips, the headlines scream panic. But if you listen closely to Matt Hougan, the real story isn't the price drop, it's the hidden shift in who's actually buying and who's desperately rushing for the exits. Matt Hougan's analysis provides a clear framework for understanding Bitcoin's current volatility, particularly as the asset dips below $85,000 amid a broader risk-off environment. Hougan highlights that much of the selling pressure originates from retail investors reacting to anticipated corrections tied to the historical 4-year cycle, while institutional buyers quietly accumulate, creating a structural divergence in market behavior. This dynamic suggests that short-term declines may not indicate fundamental weakness but rather reflect the interplay between cautious retail sentiment and strategic institutional positioning. Hougan further frames Bitcoin as a canary in the coal mine, noting that recent sell-offs coincide with macro concerns such as AI revenue sustainability, private credit fragility, and a potentially hawkish Federal Reserve. This perspective positions Bitcoin as a high beta reflection of global liquidity conditions rather than an isolated narrative. Additionally, Hougan emphasizes that bear markets often require the collapse of speculative hype cycles, with phenomena like DTs, DeFi looping, and basis trade strategies serving as examples of structural cleansing before the market can recover. His long-term outlook underscores that Bitcoin is more than a short-term trading instrument. It anchors a broader crypto ecosystem whose primary use cases, Bitcoin, stablecoins, and tokenization, are expected to expand into a multitude of new applications, including digital identity and a DeFi renaissance, solidifying its role in a rapidly evolving financial landscape. If you found this breakdown valuable, make sure to drop a comment, share it with fellow investors, and subscribe for more sharp, data-driven crypto insights.
So I'm not shocked. What I think I've realized is that I misweighed 2 forces, right? So if you think about what's going on in the market right now, Harvard is buying and retail is selling, right? Abu Dhabi is buying and crypto natives are selling. And I think when we entered the year, the assumption was that the massive purchases from institutions and corporations would be more than enough to soak up any additional supply from retail selling. And I think the element to which I'm surprised with is that there's more retail selling than I anticipated. I think the thing that I didn't factor in was people, I think, pre-freaking out about the 4-year cycle and wanting to dodge the 30, 40, 50% pullback in the market that they saw coming in 2026. I didn't think about that psychological effect. I think that's what we're living through. I think we have to finish living through it and then we bottom. But I do think we're sort of short-circuiting the 4-year cycle now, probably closer to the bottom than the start. And I think it's still upward over the long period of time. What I was thinking about there is I remember back when Bitcoin first turned down at like 120 and it started going down. I remember more recently when it started to flirt with going below 100K. And Ryan and I had some conversations that Bitcoin is sometimes the canary in the coal mine. Not always, but sometimes it's the most risk-sensitive asset. And it's the first thing people sold. And the thing that was happening outside of crypto was people were starting to worry about the circular nature of AI revenues. They were starting to worry about Jamie Dimon's cockroaches in the private credit market. They were starting to worry about the Fed turning hawkish even as economic conditions worsened. And so the thought that occurred to me when we first started going down was this may not be crypto specific. Crypto may be showing us which way the market's headed. And sure enough, the market did follow that. Like it started to emphasize these negative narratives. You're hearing words like AI bubble more. You're hearing words like consumer credit crunch and delinquencies in auto loans and those sorts of things. And so it occurred to me that, you know, we were so insular in crypto that the thesis I said at the start of this show that what's causing us to go down is crypto native people worrying about the historical 4-year cycle repeated is so mirror gazing that maybe I should step back. And actually what's happening is the market is going broadly risk off because of concerns about AI revenue. That's not my base case, but I think it is something worth considering. And that's why I threw that tweet out there. I mean, the beautiful thing about crypto is that your bullish or bearishness right now depends on your timeline. If you're focused on the next 3 weeks, it's hard to find someone in crypto that's uber bullish, that's like jamming the buy button. People are tentatively and painfully making small incremental buys if they're gutsy, but no one is like, this thing's going to rip tomorrow. If you ask people, what do you think about the next 3 years? I bet the same people who turned bearish on your show, LG, will say they're very bullish. Because over the next 3 years, you have trillions of dollars of institutional capital moving in. You have the Genius Act going into effect in a year. You have huge growth in stablecoins, huge growth in tokenization. It's really hard to be bearish over the long term. So I think the way we thread the needle is we talk to, mostly institutional investors and financial advisors who do move on like a 3 to 5 year time frame. And they're looking at this asset and saying, yeah, looks pretty good. We can buy it at 90 instead of at 125. That's great. So I really think it comes down to time frame. And that's the big discrepancy in crypto right now. Another characteristic of these bear markets is you have to take the hot buzzword and completely kill it, right? So like during the ICO bear market, we had to take ICOs and grind them into the ground. And then we had to take DeFi and take it out back and completely kill it. And then we had to do the same with meme coins and NFTs, right? And then
NFTs,
you didn't get to the bottom until those words were dead. The words for this cycle that we're in the process of killing are DATs, DeFi looping, and the basis trade. And I think those were the three things that like bubbled up and everyone was talking about, right? And became common stance. And they're just in the process of being destroyed in the same way that NFTs and meme coins and ICOs were in the past. And probably when we get to the bottom of that, when everyone's like, DeFi looping, are you crazy? That's for degens. That's the point where that's probably exhausted and we're ready to go back up to the races.
Oh man, great point, and also hilarious. What about perps? What about leverage trading? Is that one of the words that's going to die in this time around?
Good question. I mean, I don't. The idea of like either risk-free leverage trading through like asynchronous basis trading should die. The idea that was a risk-free income was just not true. Leverage won't die. Leverage never dies. But the idea that you could use like perps to do a complicated basis trade and generate a 30%, like that has to die. And it's that one's in the process. That one's pretty far down the chain in terms of its death.
Crypto's past may be messy, but as Matt Hougan shows, the ideas that refuse to die are often the ones that end up reshaping the entire financial system. Matt Hougan's perspective sheds light on a pattern that has quietly shaped every major phase of crypto's evolution, and his assessment carries important implications for Bitcoin's long-term trajectory. His argument that early versions of key innovations often fail before returning in stronger, more credible forms aligns closely with the broader market structure Bitcoin now anchors. The collapse of early ICOs, despite their flawed foundations, did not diminish the value of open capital formation. Much like Bitcoin's early volatility never undermined its core monetary proposition. Hougan's view that regulated, well-architected ICOs may re-emerge through frameworks shaped by figures like SEC Chair Paul Atkins and Coinbase's self-regulatory model echoes the same pattern seen in Bitcoin's institutional rise. Legitimacy follows structure. His broader point that crypto's narrative extends far beyond Bitcoin, stablecoins, and tokenization highlights how early infrastructure has matured to support an entirely new wave of use cases, many of which could enhance Bitcoin's relevance as the foundational settlement layer. The expected emergence of digital identity, privacy solutions, and DeFi renewals, along with future systems that may span humans, organizations, devices, and even AI agents, suggests a digital economy that will increasingly depend on secure, neutral, decentralized value rails. In that context, Bitcoin remains the anchoring asset in a rapidly expanding technological frontier. Let's get back to the interview.
To think about the story of crypto and all these things that become really big deals is that there is an initial version that bubbles up and then people are like, nah, right? There were initial versions of stable coins. There was DAI and such. And then people were like, no, and there were abuses like Luna. And now we're in the stablecoin bull run. When ICOs were happening, back in 2017, 2018, there was a lot about them that was great, right? They allowed retail participation in new engaging ideas. They were an efficient platform for raising money. The problem was they were mostly scams and you couldn't build a token that had real economic value. Those were big problems to be sure. And that's why that died a grisly death, and it should have. But there is nothing that made the fundamental act of raising capital not interesting. And if you listen to SEC Chair Paul Atkins, he's now saying you can do ICOs in a well-contained format with proper oversight, and that will be a new way to catalyze capital formation in the US. He said that in a speech in July, and Coinbase is launching it now in November, right? Doing Monad as the first example of an asset. I think it's very possible that next year we see a rebirth of ICOs, of really interesting projects with well-designed tokens that give economic rights to their users. They're not just governance tokens, and that everyone can invest in. And that's a new major way of capital formation. I think it's a pretty big deal. I also do think, to tie to the other point you raised, look, I think everyone's looking at crypto and says we have three major use cases. We have Bitcoin as digital gold, we have stable coins, and we have tokenization. I think what's happened is that we've built good infrastructure for 15, 16, 17 years, and we had a hostile regulatory environment that prevented real use cases from entering into the mainstream. And now we've lifted that regulatory lift. And I think Bitcoin, stablecoins, and tokenization is just the tip of the spear. I think we're going to see maybe 6 major use cases bubble up next year. I think you're going to see ICOs bubble up. I think you'll see digital identity. I think you'll see privacy. I think you'll see a DeFi renaissance. I think you'll see a DPIN renaissance. I think thinking that crypto is Bitcoin, stablecoin, and tokenization is like thinking that the internet is email, search, and Amazon. What about social? What about Uber? What about mobile? What about Zoom? What about podcasting? There were a million more use cases. We have not reached the end of history in crypto. We have 3 use cases. We're going to have 30. And I think next year is the year that those are going to start to bubble up into the mainstream. The thing crypto natives may not understand is that a lot of traditional finance operates under what's called self-regulatory organizations, or SROs. As an example, when Ryan and I write content, it has to go to a group called FINRA to make sure that we're not lying about it. FINRA is not a government agency. It's a self-regulatory agency that institutional investors created in financial firms so that the world would trust us, because we created our own regulation that said we're only going to put out information that's trustworthy. And as a result, millions of Americans and Canadians and everyone else trust the content that's put out. This is like an example of that. This is Coinbase doing effectively a self-regulatory organization, saying ICOs had a lot of scams. Rather than wait on Washington to make a format that works, we're going to apply crypto native knowledge to provide an SRO type experience. And I can't tell you how much this accelerated traditional finance. And it's going to do the same here in crypto, because you'll be able to trust it. That's why Coinbase specifically is so important in this example.
The recent retreat of Bitcoin below $85,000, coupled with over $2 billion in derivatives liquidations within 24 hours, highlights vulnerabilities that extend well beyond digital assets, reflecting broader systemic risks rather than a simple technical correction. Retail-driven sell-offs appear amplified by anticipation of the historical 4-year cycle, while institutional accumulation suggests a structural divergence in market behavior, indicating that short-term volatility may mask underlying resilience. Bitcoin's sensitivity to macroeconomic stress, ranging from AI revenue concerns to credit market fragility and potential Fed tightening, positions it as a high beta indicator of broader liquidity conditions. The evolution of crypto infrastructure, alongside emerging regulated frameworks for ICOs, digital identity, and DeFi applications, reinforces Bitcoin's role as the foundational settlement layer of an expanding digital ecosystem. The current turbulence functions as a natural recalibration, strengthening the asset's structural position in a rapidly maturing market landscape. Do you think Bitcoin's recent volatility signals a short-term correction or the beginning of a broader structural shift in the crypto market? If this analysis of Bitcoin's evolving role in the crypto ecosystem added value, drop a comment, share it with fellow investors, and subscribe for more in-depth market insights.